Thank you very much for joining us. My name is Matt Wright, just to give us an introduction. And I'm joined today by Panagiotis from our tanker research team. Together, we're going to give you our view on the outlook for the tanker market over the next couple of months, with a little bit of a dip into 2020. There is a Q&A box, so if you have any questions, please go ahead, type them in there. We've saved some time for the end, so please put your questions in there, and we'll try and get to as many of them as possible at the end. So without further ado, let's get straight into it. So what do we look at? We're going to do a bit of an overview of where the market is at the moment for the dirty tanker market and the clean tanker market. What are the segments? What is driving each of those segments? Then, of course, we've got to talk about the OPEC supply glut. Tanker rates have risen since September as more crude has hit the water. So talk about what's happening there and what we can expect over the next couple of months. Russia, we're going to talk about the drone strikes, how this has reduced refinery runs and increased crude exports, and what does that mean for the shadow fleet, particularly now that we have a lower price cap. And then port fees. This is we were going to talk about USTR today anyway, but obviously end of last week, China introduced their own port fees in retaliation. So we'll talk about them and compare them with what's happening in the US. And then on the clean side, talk a bit about MR deliveries, which really are starting to ramp up and are going to hit new levels next year, what that means for the MR market. And we'll also touch on the LRs there as well. So starting with a little bit of in terms of what's happening, right? Where are we at the moment? So on the left is a sort of an index of dirty. You can see from that orange line that we exited the normal summer lull earlier than usual, rising in August into September, and so far in October have broadened those levels. A lot of this was driven by extra OPEC barrels hitting the water, but it isn't just a VLCC story. We have seen stronger demand out of the mid-sizes. On the clean side, you can see just from that line, it's been a year of pretty stable rates, steadily climbing over the course of the year through the summer. But in the last couple of months, we are seeing rates starting to retreat across most clean tanker routes. That strength that we saw over the summer on the MRs in particular to drop back. So we will be touching on that as well. So let's starting with some of the dirty tanker fundamentals. So what are driving the market? So you can see on the left, ton miles did tick higher in September after sort of edging lower over the last, since about April, over the last couple of months. This was driven by a combination of factors. Yes, VLCC growth out of the Mideast Gulf has been a very important factor, but I think it's important to recognize that the strength in the dirty tanker market is not limited to that. We've also seen a lot more long haul VLCC barrels coming out at the Atlantic, and we'll come on to how and why that occurred later. But also, you can see that green segment, that's Suezmax. We saw a huge amount of Suezmax demand in July and into August from Brazil, CPC, Kazakhstan, CPC, and just elsewhere within the West Suez that really helped lift that market. And then on the Aframaxes, we've seen a very strong Med Aframax market, and increasingly now we're seeing a lot more demand on the Russian side, which is really pulling in more vessels into that Russian trade to sort of really keep those barrels moving. And you can see about productivity, which is the deadweight tonnage of that fleet divided by demand, which is a nice proxy for just, for utilization. You can see it's ticked higher after dropping. And we expect that to continue rising into October and November, which will be mirrored in rates there as well. So generally, a very positive demand side story for the dirty side. On the clean side, a bit of a different picture, because while we have had a big increase, as you can see here, in terms of clean tanker ton miles over the summer, it has plateaued. And I think crucially, we see rates match that increase in demand that we have otherwise seen on the dirty side. There's a couple of factors here, and I think it's important to recognize that Yes, there is more supply hitting the market, but that hasn't held back productivity. You can see the chart on the right, that dark blue line has jumped higher. If there's more supply, that would have held that down. So there is genuine increase in demand relative to supply, which otherwise in a market would lift rates. But you can see from that green line there, the index, it's been pretty stable there. Now, turning to some other factors on the side, we have had more MR demand over the summer, particularly at Asia Pacific. Asia Pacific really, really lagged, and we'll come on to that a bit later. That jumped back in the summer, but that is now starting to ease. Another factor helping conventional clean tonnage is a lack of competition from Suezmaxes and VLCCs trading in the clean market. And you can see there those yellow bars there. What this is saying is, compared with last year, we have seen far less dirty tonnage trading clean. And that's just because the economics of trading in the clean market, cleaning up, are not there. The disparity, the dirty rates are sufficiently high relative to clean that there's not the same incentive to move over into that market. So, some of the main factors at the moment, and starting with OPEC. So, as of October, which is this first large dark blue bar here, the market has moved to a significant surplus compared with the last year or two. And this is because of the increases in OPEC production that have been steadily added back into the market. But crucially, as the summer has wound down, domestic crude consumption in a lot of those Middle Eastern countries has reduced, allowing those barrels that were otherwise being consumed domestically to sort of hit the export market. And that's what we've seen in September and again in October. And you can see that in the chart on the right. This is showing a count of loaded tankers, but also, and then also crude on water in the green shaded area, which has absolutely rocketed in the last 2 months. Yes, a lot of this is on VLCCs. A lot of the attention is drawn towards the increase in laden VLCCs in the market and the increase in VLCC rates. But I think it's also important to recognize that, particularly when you look at the Suezmax and Aframax, they are also above, the laden count is also above seasonal norms for this time of year. So that is adding to that volume of crude on water, but also just general bullishness across the dirty tanker segment we're seeing at the moment. And we expect that to continue. Now, so going to the point I mentioned earlier about how we've seen a long CC demand as well as the Mideast Gulf to Asia, and why rates sort of exited that summer low. We had a period between end of July and about mid-September where the ARBs from Brazil, US, and the Middle East into Asia were all positives around the same time for a relatively sustained period of time. And what this is a relatively rare scenario, and it's also unsustainable because you end up with a huge supply of crude going into Asia. And you can see that this resulted in this huge build you can see in the chart on the right in terms of Chinese crude inventories. Now, that growth has since slowed. You can see we've seen a bit of a drop back in Chinese inventories in the last couple of weeks. And as a result, the WTI ARB there has dropped back below, into negative territory. This is something that I think is going to be a big characteristic of the market over the next couple of months, which is if we continue to see a large amount of Middle East crude hitting the market, there will not be space for the Atlantic barrels unless they are priced sufficiently low. And at the moment, we've got Brent closing yesterday around 62. There is further downside potential if we don't have countries like China absorbing that, because fundamentally Chinese refinery runs over the remaining part of this year are not set to run. Going to hover around 15.5 million barrels a day. There is not upside there. So if China's taking more, it's going to be going into storage. Pause there on the OPEC. I'm going to pass over to Panos, who's going to go through some of the factors on the Russian side that we've seen recently.
Hello all, thank you for joining us today. So in this section, we will give you our latest update on the situation in Russia and what this has translated into target demand and target rates there, starting with the effect of Ukraine's strong campaign on Russian refining capacity. So what you see on the left-hand side is that the refinery runs and crude exports out of Russia remain highly inversely correlated. When capacity comes offline, the country's crude output is redirected from domestic to the international market, and more crude barrels hit the water. This, in the case of Russia, is more evident for Western ports, where the country's most refining capacity is concentrated. Now, putting things in seasonality context, in late Q3, early Q4, we did expect a seasonal rise in Russian crude exports as autumn maintenance kicked in. Uh, but Ukraine's strong campaign has actually amplified that. Here in Kepler, we calculate in September around 1.6 million barrels per day of refining capacity under some form of unplanned maintenance, a figure that is expected to drop to around 1 million barrels per day in October. The impact on refinery runs has been less pronounced as the country has pivoted to higher utilization rates in operating plants. But we have recorded a significant increase, month-over-month increase in the country's crude exports, which right now we estimate have jumped by 330 kilobytes per day month-over-month as we moved from August to September. Now, moving to the graph on the right-hand side, Sano tonnage has proved more than capable of absorbing these excess volumes. What you see here on the right-hand side is the 12-month rolling average of vessels carrying Western Russian crudes in deadweight terms. We use this rolling average as a proxy for the SADO fleet's capability to lift those additional barrels. As you can see, the running average has dropped from the late 2024 highs, which is consistent with a drop in exports over the same period. At the same time, as you can see with the light green bars, the share of sanctioned vessels has risen to approximately 55% of September, as of September 25. However, this hasn't translated to an equal drop in the fleet productivity. And why is that? So out of these 55% of sanctioned vessels, only 45% are sanctioned under OFAC, with the remaining being sanctioned under EU and the UK. In fact, the last package to include Russian vessels, it came back in January 25 under Biden administration. Vessels sanctioned under OFAC, according to analysis conducted internally here in Kepler, experience a huge drop in their productivity, which is estimated around 65%. But the same does not apply in the case of vessels sanctioned under UK and EU, where productivity levels remain significantly better at minus 20% approximately. We can move to the next slide, Matt. Of course, we have to mention that for most of 2025, crude exports out of Russia's western ports have benefited by a drop of Urals below the cap threshold of $60 per barrel. Looking at the graph on the left-hand side, you can see the number of vessels entering Russian crude trades after being absent for at least 12 months. Starting in February 2025, as Urals started trading below the price cap, the rate at which fresh tonnage entered Russian trades increased, with a notable reference going to March 25, where you can see that approximately 16 Aframaxes and 7 Suezmaxes, for a total of 23 vessels, entered the Western Russian crude trades. This had a double effect. So, on one hand, it helped bring down Russian freight rates, and on the other, it supported mainstream mid-sized markets as tonnage withdrew from mainstream position list. Looking into September, however, the first month where the price cap has been lowered to $47.6 per barrel, and Ural trades have once again come above the price cap. We have seen a decrease in new entrants. It's approximately 3 LR2s, 2 SLMAXs, and 1 LR1. This trend is likely to persist in the foreseeable future as the cap keeps readjusting to catch up with crude oil prices and their trajectory. So this means that we will see lengthening position lists in the mainstream commercial fleet, and perhaps see also some challenges in Russia's ability to push its crude output to the international market. Now, that being said, in response to these two factors, namely the expanding list of sanctioned vessels and the floating cap that prevents mainstream tonnage from entering Russian trades, Russia has developed a more dedicated fleet. On the graph on the right-hand side, you can see the number of vessels that participated in Russian crude trades over the respective quarter. That's the actual number, not a rolling average. For each vessel, using Kepler data, we retrieve the ton miles, and we see what percentage of these ton miles includes parallel trades. And our definition for a parallel trade is that those that include either Russian liquids, that being crude and clean, or Venezuelan and Iranian liquids. Vessels that are in the 100% bracket, which in the graph has a blue dark color, are doing exclusively parallel trades. You can see that in Q1 25, Q2 25, we had an increase in flexible lifters that were doing Russian business from a percentage in a percentage from 0 to 1%, let's say, to 99%. But there has been also significant growth in the number of vessels that are doing exclusively Russia, reaching a record of 380 vessels in Q3 25. It's important to note that these vessels are actually active vessels. That means that that they are not idling. We actually retrieve their ton miles to come up with this study. We can move to the next slide. So leaving crude trades aside for a moment and looking at clean trades, the very same drone strikes that have triggered a surge in Russian crude trades have suppressed the country's clean exports. You can see on the graph on the left, top left, that the Russian exports tend to seasonally drop in September, clean exports. But this September, the September of 2025, has recorded a new low. Perhaps the majority of losses has come from the country's western ports, as you can see on the graph on the bottom right, mainly from the Baltic and the Black Sea. This, in return, has pushed a tonnage out of Russian clean trades. Due to the nature of the price cap, when it comes to product trades, it is a bit more tricky to determine whether a vessel has been in breach of the gap when carrying Russian products. As a result, these vessels are usually, they can easily find employment in the international market once the demand from Russia is not there anymore. And this is depicted in the graph, on the graph in the right-hand side, where you can see the employment of Russian clean tonnage per loading region. That's over the past 2 years. You can see that over the past 2 or 3 months or so, as clean exports out of Russia have started to descend, a lot of these vessels have migrated to alternative trades, mainly in the Middle East and India, where they have lengthened the region's position list. And moving on to the final slide on Russia. Matt. We wish to momentarily leave Q4 behind us and to take a glimpse into the first quarter of the next year and look how the secondary sanctions against the barriers of Russian oil are likely to affect tanker fortunes with the 18th package of EU sanctions coming into effect. So let's start with clean trades. Europe still heavily relies on discounting on buyers of discounted Russian crude barrels for its gas oil balances. You can see from the graph on the left-hand side that combined gas oil imports from two of the main hubs of processing Russian barrels, namely India and Turkey, have fluctuated between 10 and 15% of the continent's total imports in 2025. So starting with India, which has obviously, you can see on the graph, the largest share. In a scenario where India continues to buy from Russia, we may see Europe pivot towards the Middle East. This might prove net positive for the LR east to west trade, actually, as India has traditionally been the exporter to utilize larger assets, that is, Suezmaxes and VLCCs, for trades in a specific route. Looking back in 2025, approximately 32% of India's exports to West were conducted on larger assets, a figure that drops to just 12% in the case of Middle East. That's volume-wise. In reality, though, it's highly likely that the Middle East will not be able to compensate for the shortfall, and in this case, it is highly likely that Indian CBB barrels will still find their way to the continent, but through an increase in middlemen, with the trade being fragmented and injecting more inefficiencies to the clean tanker market, which is always a good thing for tankers. A similar case of inefficiencies is expected in the case of Turkey. A most obvious one is the continent pivoting towards the US to compensate for the shortfall with longer transatlantic routes supporting the MR demand in the west of Suez. Now, of course, when it comes, the million-dollar question here is, will the EU be able to actually stick to this regulation and check that the barrels are indeed not coming from Russian processed crude? At the end of the day, we're talking about molecules here, right? So the truth is that as of the time, as of now, we haven't seen any clear guidelines from EU regulatory bodies. But we have recently seen some guidelines coming from the from ICE and its gas oil contract, where we have seen uh, uh, a series of rules coming into effect that checks the refiners and they're through using vessel tracking data, using bills of lading, to make sure that Russian oil has not been processed in the past 2 months. So hopefully this will give us some clarity as to the how the regulation may be actually implemented and how Europe actually might pivot away from these barrels. Now, moving on to the crude side of the things, it all comes down to how a potential departure of India from Western Russian barrels plays on the country's production. Here we identify two scenarios, one where China absorbs the excess vessels, that would be probably Urals and from Western ports, and one where Urals production actually drops. So in a scenario where China absorbs most of these barrels, we see the shadow fleet benefit the most, while commercial VLCCs are likely to take the largest hit as China pivots away from Middle Eastern barrels. And this pivot of China away from Middle Eastern barrels is likely to offset any upside to the market coming from India returning to alternative mainstream suppliers. Now, in the second scenario, where actually Urals production just declines, that will have the inverse effect. We will see commercial vessel VLCCs being boosted, while Sado fleet is going to take the largest hit. VLCCs will be boosted because India will have to return to alternative markets in the Middle East and the Atlantic, most notably WAF, where crudes have high diesel cuts. And unfortunately, Sado mid-sizes will take the largest hit, which, in case they manage to find employment eventually in the international market, might depress position lists for the of the commercial fleet. Now, this Urals decline scenario has a lot of parallels with a scenario where Russian production drops not as a result of reduced buying from India, but because there is a scenario where Ukraine expands its drone strikes against energy infrastructure on the upstream side of things rather than on the downstream, leading to a similar effect. And I think this pretty much summarizes what we see for Russia right now. We can move to the port fees, Matt.
Great, thank you very much, Panos. And just a reminder about using the Q&A. Also, apologies if my connection has been a little bit unstable. I'm not sure what's going on there. Hopefully it improves somewhat, and apologies if my audio is not very, very clear. So moving on to the port fee. So as I said, we were going to cover this, but we've given us a little bit more attention than we were planning. So this is something that we addressed for anyone who joined us for the webinar back in July. We talked about the USTR because the US came out with the clarification of the rules. So just as a reminder for what they are. So the US distinguishes between Chinese built and Chinese owned, and they have different rules governing the port fee allocation there. So for the US built, and largely just because there are so many US built vessels, not just in the tanker space, but across commercial shipping, there were a number of exceptions. For example, if the vessel arriving is ballast, if the voyage is within 2,000 nautical miles, and if the cargo is under 80,000 tons. So when we applied these to 2024 crude, 2024 oil trade, I should say, the main market affected was dirty imports, and of that mainly crude. And this is crude cargoes from longer hauls, so VLCCs maybe into Pad 5 or into Pad 3 that have come from the Mideast Gulf or outside of the sort of that 2,000 nautical mile region. And they accounted for just under 10% of, so the Chinese built vessels accounted for just under 10% of trade there. Now, while that seems high, we do expect this to be relatively straightforward to avoid, considering those exceptions and the alternative routes that those vessels can take in the market. Turning to Chinese owned and operated, where there are no exceptions. So here, analysis over the same period, over 2024, showed that VLCCs and the MRs were the markets that were most at risk. VLCCs were Chinese owned and operated VLCCs accounted for over 20% of imports and exports in last year, and MRs was just under 15%. So these were the sectors that we wanted to address specifically. And we think that while they, particularly on the Vs, that is a particularly high share, there is reason for those vessels to be able to navigate around that. One being we actually expect to see growth out in other regions and from a VLCC export point of view, such as Brazil to Asia. And a lot of those vessels will just opt to do those routes instead. But also for exports from the US Gulf, reverse lightering accounts for a large share. And while we cannot be sure, there's been no clarification about whether a load via reverse lightering would count as a port call. We think it might not. And so a lot of those vessels will be able to be still fundamentally load a US cargo, take it to Asia, and not be subject to the port call. On the MRs, there's no real workarounds. And so for those Chinese owned owned MRs, they fundamentally need to avoid the region because the fees are a significant share of freight. In excess of between 50 and more than 100% of current freight rates. So fundamentally, too high to absorb and then make that cargo profitable. Further analysis of where we are, in terms of have we seen any behavioral changes, based on the current locations of VLCC, Chinese-owned VLCCs and MRs. Earlier in October, we had, over the first 2 weeks of October, we had a look at where these vessels are compared with the same week in 2024. And you can see we've seen a drop in North America for both Vs and MRs. And on the Vs, we've seen a lot of them relocate to an increase off West Africa. And then on the MRs, it's just sort of been a bit of a distribution, but fundamentally more in the Middle East and Asia. So we are seeing the behavioral changes that we expected in terms of vessels will need to avoid. But what we aren't really necessarily any underlying change in the freight rates on those routes affected. As we expected, the market is pretty much just absorbing this impact. In fact, I would say that there's other bigger factors involved at the moment. Now, in saying that, on Friday, China announced the special port fees targeting US owned, operated, built, flagged ships. And we have undertaken to try to understand what the implications of this would be. So, one thing that I think, just to be look at the distinctions between USTR and the Chinese port fees is the Chinese port fees make no distinction between whether it's owned or built. They lump them all together, and they also include vessels that have 25% or more equity by a US individual or organization. Now, that is actually a very, very difficult figure to calculate. For some owners that have large institutional investors, that's more straightforward to understand if they have a large equity share from the US. But there is a lot where it will be very, very ambiguous. And I think this is going to be the fees are going to be applied at by the local maritime authority within China. So it's still very unclear. It was announced Friday and came into effect yesterday. It's very unclear how vessels are going to be treated where the equity share is unknown. So for the purposes of this analysis, we're not taking into account those where the equity share is unknown. So the chart on the left is just focused on owned, built, and flagged US vessels. And here you can see that based on port calls between the start of 24 and now, VLCCs account for the majority of that, that US fleet at just under 4.5%, at 4.5%. Now, again, much like with the USTR fees, this is a disruption. It is inconvenient, but from a freight macro point of view, we don't expect it to be a driving factor determining freight rates. What could, however, be is the fact that we have so many unknowns about whether a vessel is or isn't. And what we might see is a situation in which there is a very clear two-tier market for vessels that can absolutely guarantee no US equity involvement and provide that, which makes it very, very straightforward from a chartering point of view, versus the others where there's some ambiguity. And I think that would obviously be the listed owners would have more trouble doing that rather than the privately owned vessels that can show they are not. But that is more of a transitional period as the market tries to understand how to manage this. For the other sectors outside of the Vs, we don't really think there's going to be much disruption. As you can see, all of the shares are below 2%, which, even though there's a decent number of US owned operated flagged vessels on, let's say, for the MRs, very few of them have actually historically called at China. So we don't expect that to be an issue. Comparing the two, the chart on the right, you can see that the actual fees are broadly similar on a US dollar basis. The Chinese fees are ever so slightly higher, but by and large, they're sort of going after a similar goal here. So I think the now question really is, are these going to last? My view is I think these are all now eligible for discussion under US-China trade negotiations. I think that it's potential that they could both be watered down or not. But at the moment, after a bit of warming in trade relations, I should say, over the summer, we've now hit another period, particularly after the US sanctioned the Ruzhou port in China last Friday, which is again a very significant development. The port accounts for 10% of Chinese crude imports, and crucially, because of science, previous ports that the US has sanctioned have been more independent. This one is partially owned by Sinopec, and it is also a very important sort of connector terminal to inland refineries about 800,000 barrels a day of refining capacity is linked to those ports. So the this is a much more serious development in terms of sanctioning than when previous ports were sanctioned, and it will be very interesting to see how China addresses this and whether the terminal whether we see a drop in flows into the terminal. The We've seen two vessels already divert from going to Rizhao to Ningbo, and that is also connected to some of those inland refineries, but not entirely. So, it's still very early days, but I think particularly when we're looking at that VLCC outlook, this could be significant because if it does affect Chinese refineries, we're going to see a drop in crude intake. So now turning to the clean side. So looking at the chart on the left, this is what we're looking at here is MR clean exports by region compared with the average for 2023 and 24. So the main thing here is that dark blue line, Asia Pacific. For the first 6 months of the year, averaged well below 23 to 24 averages. And in the summer for 2 months has moved above and has now since dropped back. That has been a real anchor. That has really weighed on the market over this year. Even, west of Suez started slow, and then the Middle East and India has sort of fluctuated. But fundamentally, we're not seeing as strong an Asian market than is necessary, considering the amount of vessels that continue to hit the water in Asia. Obviously, they are all being delivered in Asia. They then might subsequently bond. The chart on the middle is sort of highlighting, the disparity in earnings between the region. So at the moment, you can see from that blue area, the MR earnings in the Atlantic are at a significant premium to the Pacific, and a big part of that is we've seen the share of MRs operating west of Suez fall to a multi-year low. I think it's the lowest since around 2022. So we are due to see a blip back. We're going to see, this is depressing earnings out of Asia, and with very little on the horizon in terms of strong new demand. Clean flows into Southeast Asia this month are well below 5-year average. So there isn't a lot of strong demand signals there. So we do expect to see a net shift of MRs from the east of Suez, specifically Asia Pacific, to either the Middle East and the Atlantic to help address that. That will help alleviate rates in the east, but it will also put a bit of a dampener on earnings in the west. But we are expecting to see an increase in PAD 3 exports in the next month as those refineries come back. But the main thing that I think is on the horizon for the MRs is the order book. So Q4 is a relatively quiet period with just 15 scheduled to hit the water over the course of this month. But it is really 2026 when things start to get heated up, with over 30 expected in each of the quarters of next year. And that is going to sort of require some changes in the dynamics. So a couple of things that I think could be up for discussion is we've got 50 MRs moving into the 2020 to 25 bracket. So this is sort of, we're now entering the territory of, are we going to see some scrapping? Considering the growth in new builds and that the market we haven't seen, and we're not expecting to see tremendous growth in ton miles, there is definitely scope for that. Turning to the chart on the right, what we're looking at here is what growth in ton miles would be required to just maintain current levels of MR productivity. Bear in mind, that's a 5% increase year on year. Bear in mind, this year, we're expecting ton miles to fall 1% year on year by the end of the year. So that would be a real change. So I think we're going to see productivity declines unless we see significant scrapping. I think on balance, might see some scrapping, but it's more likely we're going to see some large productivity declines. And when we see productivity declines, we see lower rates. So I think it's very likely that MRs are going to come under pressure next year, even more so than we have seen currently at the moment. And then finally, looking at the LR market. So LR rates, really were one of the main beneficiaries of the disruption to Red Sea transits. And we saw ton miles absolutely rocket at the beginning of 2024. But what is interesting is over the first half of this year, LR ton miles from east, so from the Middle East Gulf and India to Europe, actually fell below pre-Red Sea disruption levels. And the reason for that is not because vessels are no longer taking longer voyages around the Cape. They are, the vast majority are still taking the Cape route. It's we're just seeing lower volumes, fundamentally lower volumes. And that is because Europe is importing less diesel as demand declines. But also it is pulling in more diesel from within the Atlantic, specifically the US. So what that is doing is it's sort of reducing what was once, what has been one of the big sort of boosters to LR demand. At the moment, we're also going through a period where naphtha flows to Asia are falling, and ton miles on that route in September dropped to a 1.5 year low um, on for LR2s. So collectively, we're going through a bit of a weak period, and we're not really expecting to see any significant rate growth until mid to late November when those steam crackers in Asia come back from maintenance. Adding on to this, LPG as a feedstock is also pricing slightly better relative to naphtha. So I think collectively, it is going to be a bit of a tricky month or two, but we could see a much stronger December, particularly if utilization rates rise, as we're showing on the chart on the right in December. That should really help the market there. And then finally, to go through some of our view of the markets. So bullish on the larger dirty tanker vessels. Now, a lot of this is fundamentally due to that crude surplus we're seeing in the market. It does rely on a couple of things happening, which is that we have countries like China continuing to buy. Whether we need to see a lower flat price for them to incentivize that is an issue. But we also have non-OPEC growth. We've got Brazil, we've got Guyana, but that's obviously less of a factor over the winter months, which I'll come on to. There are some negative factors. We should see less, that growth in Brazil may find it difficult to get into Asia if the arb is not workable. And then also, as I mentioned, those Chinese port fees and the sanctions on Rujal is an issue, and that could weigh against what would otherwise be a more bullish market. On the Suezmaxes, we've had a very, very strong period with CPC, Brazilian increase. For Guyana, we have loading restrictions on VLCCs since September through to February. So that is all of that growth in sort of new fields coming online is going straight into the Suezmax market. So that is going to be very, very supportive there. And also, I think one thing we often think of Russia as more of an Aframax. There's the growth in Russian exports that Panos highlighted is also supporting Suezmaxes. And then also OPEC, we think of OPEC as a VLCC driver. We are seeing more and more Suezmaxes from the Middle East Gulf to India, but also to Asia, to Eastern Asia, because of how high VLCC rates are. And that's definitely something I think we need to be aware of, that the Suezmaxes, where the connection between the Vs and the Suezmaxes is going to come. As we mentioned, Russia is really driving the Aframax market at the moment. We've seen record high TMX volumes into Asia on Aframaxes, also very supportive. Very strong med market with Libya and Middle Eastern barrels coming out of Egypt, really, really lifting flows there. However, on the Aframaxes, the weak LRs means we should see some clean to dirty switching over the next month or two until we see some better earnings coming out of the LR market. And fundamentally, the competition from Suezmaxes is going to just remain, even though they're not trading. If LR2 rates were to get high, they're fundamentally capped at a ceiling by wherever the Suezmax market is. On the clean side, the clean to dirty switching will alleviate some supply side pressure on the clean market. And the fact that, despite ongoing peace talks, I'll say peace talks because I don't feel like yet within Israel and Gaza, that we have got to a point where there's any real stability. But I don't expect, even if we have a sustained ceasefire, it will take a lot longer before we see any return to significant trade flows through the Red Sea. Um, the Houthis are yes, their attacks started in relation to this, but I think they will persist. You know, and I think owners will remain very skeptical about taking the Bab el-Mandeb Strait for a long time. So I think that is going to keep flows around the Cape for a bit longer. Cracker maintenance expected to go through until end of November, as we mentioned. Fleet growth there, and the weakening European import fundamentally. And then lastly, on the MRs, we've got I have talked about all the negatives, but there is some strong demand side stories. US Gulf, the US Gulf clean exports are expected to rise again at the latter half of Q4 as those refineries come out of maintenance. PAD 5 imports. This is the big new sort of demand side story for MRs. Those refinery issues and closures is going to continue to support trans-Pacific flows. Even this time of year, which is particularly strong, uh, demand side for gasoline and jet, we are seeing well above seasonal levels in terms of Asia to PAD 5 flows. And then on the but fundamentally, large fleet growth is really what's going to weigh on the market over the next year for sure. With that, I will turn to the Q&A because we've had definitely had a few come in now, and we'll go through them. Let's take a look. So, asking if we have a similar chart for VLGCs. We do, but a different team is looking at that. We will get back to you by email to address that one if that's all right. And it says, for the 25 production in Russian flows to India chart, what assumption do you use where the oil goes? What's the split by region, by country? Yeah, so this is the one that Panos highlighted earlier, which is the two scenarios on if we saw a reduction. So we did a very, very straightforward scenario plan. So what we looked at was, first of all, the 25% reduction is based on what we consider to be a realistic reduction in what India might take, because we think even under a lot of pressure, India will continue to take a decent amount of Russian crude, but also a 25% reduction in Indian crude to go to China would take total Chinese imports of Russian crude, seaborne and pipeline, to around 25% of total, which we consider to be a ceiling in terms of how much China would be willing to take from a single supplier. So that's why we've sort of got to that level. And the assumptions are, I'll go back to the chart just so we can address that in one and look at it. So we have a flood breakdown on this, but what we assume is India will replace Russian barrels with US, WAF, LATAM, and Middle East crude, and a spread across mainly VLCCs, but also Suezmaxes. And China will back out if it takes more crude, will back out Middle Eastern predominantly, but also WAF, LATAM, but they take very little US, so we haven't really considered that. If it's of interest, we can share like a waterfall that kind of breaks that down in a little bit more detail. Next, gas oil looks tight for Europe and the Med following the damages done in the Russian refineries. Does the fact that US has loose balance and might expect more to Europe following the new trade render the Russian situation less concerning? I'll give you my thoughts, and Panos, you weigh in as well. No, and I think the reason is a lot of those Russian barrels have been going to the Med, Brazil, WAF, etc. And what we've actually seen is when those Russian barrels kind of came offline, Brazil was sourcing additional barrels from the US and essentially creating a bit more tightness in the gas oil market at that time because and so you have other countries battling over. I think if you take those Russian barrels out of the market, you'll be putting more pressure on the rest of the system. Panos, would you add anything there?
No, I completely agree. It's it essentially comes down to Europe competing with LATAM, where you also have significant losses because of the departure of Russian volumes, competing over US and Middle East Middle East and Indian volumes. So yeah, it doesn't seem to be that loose of a situation for gas oil balance.
Yeah. Someone has asked if we can touch on 25. Unfortunately, not this week, but that we will be getting into that in 2026. Obviously, part of the reason is it's, the impact on the market has not been hugely significant yet, but we will be getting more into that side of things in the next couple of months. Somebody has asked, so Matthias has asked your view on the Red Sea normalization. So I may have addressed this since you asked the question, but you've asked specifically east to from AG India to EU through Suez recovered a bit. Yeah, so we have seen some Indian cargoes take the Bab el-Mandeb Strait from the Jamnagar refinery into the Med. We've also, on the dirty side, on the crude side, we've seen some Iraqi cargoes take that route. So there is a slight increase in crude and clean flows taking the Red Sea route on the east to west compared with, say, 6 to 12 months ago. However, it is still far from sort of that higher normalization. And I think when you look at a lot of the vessels that are being used, these are vessels that often are taking Russian crude. So, for example, for the Basra, a lot of them are taking Russian crude from the Baltic and the Black Sea to India, and then they pick up Basra as a backhaul. So you're not necessarily introducing new vessels to the Bab el-Mandeb Strait situation. I can't comment actually on the clean vessels, whether it's the same there, but that's the big change. You need to want until we start seeing vessels that have not gone near the Bab el-Mandeb Strait for the last 2 years. We're not going to really see any significant change in flows. Panos, would you add anything else on that?
No, I think you've covered it thoroughly. Yeah.
Okay. Great. Otherwise, I think we've addressed all of them there. Thank you very much for joining us again this afternoon or this morning, wherever you're from. And yeah, we look forward to hopefully joining us again in a couple of months. Take care.
Matt, we have a question that might be interesting to you. The
Oh,
AIS data from Iran.
yes, yes. Yeah, sorry, we just had one poke through and on the buzzer. Do you see an explanation for Iranian tankers resuming this week's tracking? Yes. So for people who aren't aware, um, in the last 48, 72 hours, a lot of the vessels that handle Iranian cargoes have turned their AIS back on. And this is exceptionally rare. I mean, for the first time in 7+ years, we have seen more AIS pings from these vessels than we have done. Now, we actually wrote an update on the platform. So for Kepler Insight subscribers, please go and check it out. There are theories for why this might be, and they range from the fact that, considering the UN snapback in terms of sanctions on Iran came in, there there's some argument that these are vessels want to make it clear because a lot of the snapback is related to the handling of weapons and things related to the nuclear industry. These vessels want to get very clear. We're just handling oil, not, and there's lower risk of them being seized. That is one argument. There's another argument that they want to show greater transparency to buyers in Asia that that they are where the cargo is coming from and how it's being handled. But again, we've seen this is such a long established behavior of dark fleet. Another is that China, particularly following the Rujao sanctions, this is interesting that it's happened just after that. Because one phenomenon one thing we noticed is after some of the independent terminals were sanctioned earlier this year, a lot of OFAC sanctioned vessels were now calling at those ports, and basically those ports, most ports in China don't accept OFAC sanctioned vessels, but for example, I think it's Dongjiao was sanctioned earlier this year. That now has one of the highest shares in terms of Chinese ports taking vessels. Might Rujao go down the same route? Now it's very, very different. This is, obviously partly state owned. But this could be, some tacit communication between China and Iran. along the lines of, maybe we just don't need to bother anymore with this cloak and dagger behavior, and we need to let's just disregard. However, I would add that OFAC sanctions are fairly serious, and it does make seeking finance, doing business, and being at risk of secondary sanctions for anyone who does do business with you, incredibly difficult. So, yeah, we don't have a full explanation. I think it would be interesting to see if we have full voyages completed with the AIS signal on. Do we see STSs taking place? Do we see less? Do we not see any STS and the vessels continue all the way to China? I think over the couple of days and weeks, that will be the proof of what is happening. Is this a permanent change in the logistics network of Iranian crude? Anyway, apologies. We got it in just there at the end. Um, yes. Oh, okay. One more. Why are US sanctions more effective than EU and K at reducing Russian exports? Um, I think this is just the ability of the US and the influence it has over financial markets. What's your view there?
Yeah, 100%. And it also, I think also has to do with the involvement of India in the US dollar markets and the US currency, whereas, the exposure to European currencies and UK currencies is not as big. So Russia crude trade being so connected with India and appetite, India doesn't want to be in the bad books of the US to the degree that they can. They're going to avoid it. That's why probably we see OFAC sanctioned vessels having this significantly larger drop in productivity.
Yeah, absolutely. Great. Well, again, thank you very much. And yeah, look forward to seeing you all again soon. Take care. Bye.